Banks are secretly judging you based on reasons they never tell you about. And one of these methods that banks like to use could be the reason why your applications get denied more often. Banks like to hide the fact that they create their own internal credit scores for each customer that you can't see. They approve and shut down accounts without a human being present. And there's one thing that's completely out of your control that directly affects whether you get approved or not on a regular basis. Now, most of this info comes from two separate interviews with a large bank's back office executive and another bank's underwriter. You know, banks have their own way of figuring out if someone is a good bet for a loan. They don't just rely on your FICO score, which is the number most people talk about when it comes to credit scores. Instead, they've got their own internal scoring models, and they're always tweaking these scores to make them better. These models look at a bunch of different things, not just your credit score. Just like Navy Federal Credit Union is well known for their internal scoring system, which they'll use to judge you and approve you for new products with them. One big thing banks tend to look at is how you've been making your payments. It's not just about whether you pay on time, but also how regularly you do it and how much you pay. Like if you always pay your full bill on time, that looks better than if you're just paying the minimum amount now and then. Another important part of their scoring is how much of your available credit you're using. This is called credit utilization. If you're maxing out your credit cards all the time, that might worry the bank. It could look like you're struggling financially or not great at handling your credit. But if you're only using a small amount of your available credit and you're paying your bills on time, that's a good sign. It shows you're responsible with your credit. So these internal scoring models help banks get a clearer picture of your financial habits and how risky it might be to lend money to you. Next, you probably didn't know when you apply for a credit card, about 80+% of the time, a computer algorithm decides whether you get the card or not. This shows just how much banks rely on automated systems now. These systems are super quick at looking through a lot of your financial info, like your credit score, your income, how much debt you have compared to your income, and your past financial habits. The goal is to make fast and fair decisions about who gets credit. But not every application gets sorted out by the computer. The other 20% needs a human to take a look. This usually happens when the algorithm can't make a clear call, or something in your application needs a closer look. Maybe there's something unusual in your credit history. Your credit score is right on the edge, or there's some other info that doesn't quite add up with you. In these cases, a person called an underwriter steps in. They take a deeper look, considering things like why there might be a baddie on your credit report, explanations for changes in your income, or signs that you've recently gotten better at handling your money. Computers are really there for handling clear-cut decisions quickly, while the human touch is there for situations that need a bit more consideration. However, the fact that most decisions are made by algorithms shows how much banking is leaning towards technology. The big reason these credit card companies are using computers to make all these approval decisions is because it's so much faster and basically costs $0 to implement. You know, the sponsor of today's video, Melio, allows you to make business payments faster than many other options out there, and it costs $0 to sign up as well. Melio allows you to pay bills using your choice of payment method, including same-day payment options like fast bank transfers and pay by card. And Melio just launched real-time payments, which lets you pay vendors instantly so your business can keep the cash on hand up until the last possible moment. One thing I like about Melio is how you can combine multiple invoices from the same vendor into just one payment. It's like instead of juggling a bunch of payments and worrying about missing one, you just tick a few boxes and boom, everything's merged into a single transaction. Saves a ton of time and keeps things super simple. And Melio automatically syncs with different accounting softwares like QuickBooks and Xero. Information like vendor details and outgoing and incoming payments gets updated on both sides. Since Melio keeps those transactions updated and you don't have to spend hours doing manual data entry, that lowers your risk of accounting errors. If you own a business, try Melio and make your payment process easier. Click the link in the description and make your first payment today. Now, have you ever wondered how banks decide when to shut down an account? When we hear stories of it happening to other people, it sounds so random, but it's not. So in the worst case scenario, how banks decide whether to close your account is mostly done by computers, not people. They use complex programs called risk models to make these decisions. These models look at a bunch of stuff about how you use your credit, like how much of your credit limit you're using, how you're paying your bills, and if your credit score goes up or down. Here's an example. If you suddenly start using a lot more of your credit limit or change from paying your full balance to just the minimum, the bank system might see this as a sign you're at a higher risk for not paying it back. So the computer might automatically lower your credit limit or even close your account to protect the bank. Another situation is when your account keeps changing payment sources, the bank's risk model might see that behavior as fraud and flag your account for closure. These automated systems help banks manage risk in a fast and consistent way. And in the world of credit cards, banks are like detectives. They keep a close eye on how you use your credit card because certain habits can tell them a lot about your financial health. They really take notice when you suddenly start piling up a lot more debt on your credit card. This quick jump in debt is a warning sign for them. It might mean you're in trouble or you're not managing your money as well as before. Another key thing banks look out for is if you stop paying your full credit card bill each month and start just paying the minimum. This change is a big deal. It suggests you might be struggling to keep up with what you owe. When you only pay the minimum, your debt doesn't decrease as much, and you end up paying more interest over time. This ends up being risky for the bank. When banks notice these kinds of changes, like a sudden increase in your debt or just making minimum payments, they might take a closer look at your account. They're trying to figure out how risky it is to let you keep borrowing money. Based on what they find, they might change your credit limit or watch your account more closely. There's also something called universal default. This is a term banks use when they take a negative action on your account because of problems you've had with other credit card companies. For example, if you don't pay a bill on a different credit card, the bank might react by shutting down your account with them. They do this because they see trouble with another card as a sign you might have problems with theirs too. And there's always been a lot of confusion around how banks determine your credit limit. It's a little more complex than what you've probably been thinking. When banks decide your credit limit, they really look into 3 key things about your financial life. Number 1, they're looking at your existing credit lines. Banks take a peek at the credit you already have, like other credit cards or loans. If you already have a history of handling your credit and all your loans well, then that's a big plus. It shows you're good with that amount of credit and you can be trusted with it. And number 2 is your income, and it's pretty straightforward. The more you earn, the higher your credit limit will be. Banks often think about 10 to 15% of your yearly income as a ballpark figure for your credit limit. They also look at how your income stacks up against any debts you have. And number 3, how much credit you're using or your utilization rate. If you're not maxing out your cards and keeping your balance low, it looks good in the eyes of the bank. They see you as someone who doesn't rely too much on credit, so they might be more comfortable giving you higher limits. You know, an interesting thing to note is that having a high credit limit and using just a small part of it is actually a good thing. It shows banks that you're responsible and not just relying on your credit cards to get by. This is a huge point in your favor when you're looking to get more credit. And when it comes to borrowing money, banks take a really close look at your credit history, especially if you've been through a bankruptcy. There are really 2 main types of personal bankruptcy in the US. That's going to be Chapter 7 and Chapter 13, and they each mean different things to lenders, which is news to me because I thought they were all treated the same, but they're really not. Chapter 7 bankruptcy is also known as liquidation bankruptcy. This is where most of your unsecured debts like credit card bills gets completely wiped out. For lenders, this is a bit of a red flag. It tells them you were in a spot where you couldn't pay back your debts and needed to start over. So if you've got a recent Chapter 7 bankruptcy on your record, banks might be more hesitant to lend to you. They're worried that you might not handle new credit well. So Chapter 13 bankruptcy is different. It's called a wage earners plan. In this case, you set up a plan to pay back all or part of your debts over 3 to 5 years. Lenders usually see this in a better light. It shows you're trying to pay off your debts instead of just erasing them. Sticking to a Chapter 13 repayment plan can look good to banks. It's like you're proving to them that you can handle financial responsibilities. And the timing of your bankruptcy also matters a lot as well. If it happened several years ago and you've been managing your money well since then, lenders might not be as worried. But if it happened, let's say, a year ago, it's going to have a much larger impact. Also, bankruptcies are supposed to fall off your credit report after 7 to 10 years. But if for some reason one remains on your report, banks will still look at it and consider it before approving you. Now, I don't think that's fair, but listen, this is just how things work these days. And when you apply for credit cards, especially with larger banks, lenders usually don't go super deep and check to see if the income that you say you have is correct. Instead, they look at your credit report and use that to figure out if your reported income makes sense given your overall financial situation. This way, they can process applications faster, looking at your credit habits to really get an idea about how much you might be earning. For example, if you say that you have a high income, but your credit report shows you only have small loans, or your credit habits don't really match up with someone making that much money, lenders might get suspicious. If things don't add up, it could lead to them saying no to your application. But if there's something really off about the income that you've stated, like it just doesn't fit at all with your credit history, the lender might ask you for proof of income. And this is more likely if other parts of your application also make them question how creditworthy you are. But if you have a really solid credit history, then they likely won't ask for proof of income. And lawfully, a bank cannot discriminate based on age, but that doesn't stop them from skirting the line a little bit. It's really about how your age relates to your credit history. Let's say you're older, but you don't have much of a credit history. Lenders will be suspicious about that. They could wonder how someone who's been around for a while hasn't used credit or financial products much. They might think you've been unstable in the past. On the other hand, if you're younger and don't have much credit history, that's usually seen as pretty normal. It's expected that younger folks are just starting out with their financial lives, so a short credit history isn't a big deal there. But if a seasoned person hasn't used credit much, lenders might be more cautious. They might think there's a risk there, like maybe there were financial problems in the past or a tendency to steer clear of credit. And I've discovered if you ask some banks whether you need to open an account with them first before applying for credit to help approval, a lot of them are going to say that it's not necessary. But that's just flat out wrong. When the bank is judging your application, having a history with the bank will definitely help, especially when it's a computer deciding. Let's say you're using an automated system for your credit application. The computer will look at your history with the bank. Things like how much money you've kept in your bank accounts, if you've had loans with them before, and your overall relationship with the bank can work out in your favor. If you had a good track record, like keeping solid balances, paying off loans, and using other bank features like balance transfer offers, the computer might see you as a safer bet. This could mean better terms or a higher chance of getting approved because the system sees you as a lower risk thanks to your history with the bank. One thing I've almost never seen discussed is the bank's mood when it comes to approvals. The exact same person that gets denied today can get approved the next month with the same credit profile. Banks always have a certain appetite for lending, and you have no control over it. Their willingness to lend money to you is going to change based on how their business is performing, how much money they have to lend in the first place, and global market conditions. And their appetite will move around from month to month and year to year. Banks really keep an eye on how their current loans are doing. They look at things like how many people aren't paying back on time or at all, and how much money they're making from those loans. If they see they're facing a lot of risk or not making enough money, they might decide to be more careful when it comes to loaning out money. This could mean that they're only going to lend to people with better credit scores. They're going to check your income more thoroughly or offer big credit limits like they used to. Basically, their past experiences with loans tells them how risky it is to lend more money. And banks have to follow some rules about how much money they should have available. It's like a safety net. This money is meant to cover any unexpected losses. If a bank is close to using up this safety net, it'll probably slow down on giving out new loans. They need to make sure they're following the rules and not putting themselves at financial risk. But if they've got more than enough money saved up, they might be more willing to lend, maybe even relaxing the rules a little bit to attract more customers. Also, what's happening in the economy really matters to banks too. When things aren't going well, jobs are stable and businesses are doing really good. Banks are more likely to lend money at that point. They're really not going to be too worried then about people not paying them back. But when the economy isn't doing great, like during a recession, banks tend to be more cautious. They worry more about people losing their jobs or businesses struggling, which means they might not get their money back. So in tougher economic times, they're likely to be stricter about who they lend to. One of the worst things you can do is apply for a credit card during a time when the bank has a poor appetite for lending. You run a greater risk of getting denied with nothing to show for it but a hard inquiry and a damaged credit score. That's why I put together a list of 5 credit cards to get pre-approved for first, so you can have close to 100% confidence that when you apply, you'll actually get approved. Don't forget to check out that video next. And if you own a business, try Melio and make your payment process easier. Just click on the link below to make your first payment today. Thank you for watching.